Hi guys, in this lecture we'll go through the nature of the market. So we'll cover how the market moves, who controls the market. We'll also debunk some concepts about institutions and about just retail traders in general. And finally, we'll go through how these big institutions, let's say, just know where most people like me and you are entering the markets. And that's why you sometimes see like your trade going against you and then hitting target straight away, which could be the most frustrating thing ever. So if we just completely bring it back down to the basics and literally talk about how does the market moves. So we know for every buyer there must be a seller, and if the market goes up, so let's say from this point here the market clearly goes up to this point there. Why does that happen? It happens because there's clearly more buyers than sellers at each price there. So the general trend of this day here was bullish, was to the upside as there was more buyers than sellers. But then as we came into here, the opposite thing happened as there was more sellers than buyers in the market. So price started to come back down again. Now, why does the market move like this? The market moves like this because it's always curious. We always say the market's curious, so it likes to go to places it hasn't been to in a while. So by that I mean the market is looking for liquidity, and by liquidity we mean areas where there's going to be a lot of orders in the market. As we said, for every buyer there must be a seller. Let's say I want to enter the market. I called the exact low in the market here, so I'm just going to mark it out. And I want to enter a buy order. So I want to buy one lot, yeah. Right there. At this price level, at this exact low, someone must be selling one lot to me for me to enter the market. Otherwise, my order is not going to get filled. And as if my order does not get filled, I'm not in that trade. But I am entering the market there because I think from this price here, it will go up, and therefore once it goes up, I'm able to profit on the trade, taking my profits from here or maybe holding it to highs if you can do that. But I'm entering the market here because I know there's liquidity in the market there. Why? What makes me think there's liquidity, or what gives me the confidence to say there's liquidity in the market, is the market hasn't traded around here in, let me just get this tool up, in over a day. So a day in 12 hours, the market hasn't traded around here. So chances are there's going to be a lot of orders in the market here ready to bid that price up, or ready to sell around here. Why do we know this? Follow standard theory, or what every retail trader is taught at the very start of the trading journey, is how to identify patterns. So anyone looking at this, you can say we've got a low in the market, we've got a high here. So from this point onwards, if that's where price comes back to, yeah. So the market is trading upwards, actually very strong with the upside. It makes a high here, yeah. And then after this move, it comes down to make this low, which is a lower low from the low we've had here. So all of a sudden, to all these retail traders, this is a perfect sign of the market being very bullish, going to the upside, because after this we see another move to the upside right there. So after this move to the upside, there's a lot of traders that are willing to look for the market to come back around this area here, let's say. So they're looking for trades to come in here and then bounce in price, because we've made this lower low here after this move to the upside like this. Market moved up, went down, moved up again. So now they're looking for that move here, which is they're looking for a new higher low to be made above this low there, above this low here, which is shown by the drawing here, and then for the market to continue to move to the upside. As soon as the market breaks this lower low, there's a lot of new traders stepping in, because now they think, as this low has been broken here, let's mark this out. As this low has been broken now, there's a lot of people that think, okay, this is a new pattern now. We've got a high, we've got a lower high, we've got a high here, we've got low in the market, we've got a lower high. So on the production, this lower high, many people are looking for this low to be broken now. Many people in the markets are looking for this low to be broken. As the market flushes down here, it breaks this low. So at this point there, as soon as that low is broken, there is a lot of sell orders going into the market, as many people believe, as many people want to trade the breakout, so they want to catch this move to the downside. And as they catch this move to the downside, think about how many sell orders are entering the market. So as soon as this low is broken, you've got rows of people buying sell orders. 1, 2, 3, 4, lots and lots of sell orders have been entered the market. So what does this do? This provides this all given liquidity for these big institutions to step in, because let's say if all these orders are only like 1 lot, 2 lots, these add up, and as more people are selling into this massive area here, because the market is now making a lower low, these institutions are just, this institution and these big players in the market are just waiting there to eat it all up. And when I say eat it all up, they're waiting there with these buy orders to buy the market back up. And if they enter the market here, let's say, on the breakout of this low here, they're likely to have the stops above the most recent swing point. So let's say they've got the stops there and they're going to be targeting. So let's say they target that low there, maybe even the lows down here, yeah, because they need a minimum two or three risk reward to get into the trade. So they'll be trading this breakout. And as I said before, all these sell orders are now going into the market. What does the bank do? That gives the opportunity, not just for the bank, but for these big players. When I talk about big players, institutions, what we mean is there are central banks and banks engaged in the foreign exchange every single day. They have different algorithms with which move price to points of exhaustion and points where there's liquidity, where there's different liquidity pools, just so they can unload their orders into the market. And this kind of brings us on to the first concept, that the banks are out to get your stops. The banks aren't out to get your stops. They don't care where your small, tiny block sizes are, because they trade in the millions and sometimes the billions. So they just need to unload their orders. They just need to get their orders into the market at certain points. And these points are the points of price exhaustion, but also the points where the market is signaling to all these retail traders a perfect entry into the market. Once the lower low is broken here, so many people are entering the market. As I said, all these sell orders are going in, and what is this doing? It's just the banks is slowly accumulating its orders, and as more orders come in, they're just waiting to start entering all of their buy orders, and as they enter the order, the price starts slowly moving up, slowly. And where does it go to? It goes to the point where stops are likely to be in the market, with people putting the stops like above, in this case, above the most recent swing high. And as soon as the market taps there, it completely turns, and you see this price action just flip the other way then, because the market's done what it tends to do. It forced price action to the point of exhaustion, to the point of next liquidity. They bought up the market down here, pushed price upwards, taking these retail stops. But they've done what they intend to do. They unload the order in the market. But at the same time, 90% of all participants in the market are all these big banks and institutions. So you can't go up there ignoring how they trade and how they operate, because you are in the 10%, you are in the minority. You need to be aware of these moves and how these institutions control the market in order to take advantage of these price spikes and inefficiencies. Because once the market moves up and down, and it has to fill in these inefficiencies, in price. So once we see a serious price spike, like in this case, say a price spike to the downside, price will have to pull back following the move, because most of the time it will be a case of bank algorithms just following the price. And you do see price literally come down here, go back up, come down here, go back up again. So what's happening here is we see a massive price spike to the downside. As the orders are getting filled in, these bank algorithms are following the price. So they have to adjust to follow the price so so they're not clipped on the trade. So what I mean by that is what we'll do is leave price inefficiencies. So as we get a huge move to the downside, eventually price will come back up to the center of that move as these bank algorithms have to adjust for the move that's just happened. So that's why we get the market move up and down constantly. And this is a perfect example of it here. Every spike downwards, we see a spike up to the similar price levels. Similar thing happens there. Massive move to the downside. We match this low there in the market, and then the market just springs upwards, and eventually people see the market does come in and trade lower again, because these bank algos are what's essentially moving price when there's no clear trend in the market or when the market's in the range. Remember, the market only trends 30% of the time. 70% of the time, the market doesn't trend. So that's where we really observe the structure of the markets and observe the nature, because the market's always curious. And another key thing to understand is the market is never wrong. It will go where it wants to go in order to find value. So it's never wrong. You are wrong on your trade idea if you thought the market was going a certain way and it went the other way. And that's a key thing you need to understand from the start. When you take trades, the market's never wrong. You were just wrong in thinking where the market was going to go, because the market moves irrespective of your bias. So if let's say you thought when it broke this high here, I'll circle this out, when the market broke this high here, you thought the market's is going to go bullish. You entered your order. There with your stop below the low, and what happens? You get stopped out immediately. In that case, let's say you thought the market was going to go up because in the euro dollar, the ECB has just came out saying there has been very good GDP figures for the euro. So instantly you're thinking that the market will go up. As soon as it hits your stop, you need to realize the market is looking for value. Like maybe it was priced in that the GDP figures were positive, so the move to the upside here was priced in, and then the market just fell through. So you need to realize you were wrong on the trade idea. But essentially, the market moves on speculators forecasting the future prices of an economy's currency. So if we talk in terms of stock price, let's say, if you think Apple will release a new product, which will be the best product they have ever released, you're likely to buy the stock in anticipation of it going up, as it will be the best product Apple has ever released. The same thing happens when institutions and businesses invest in economies where they're likely to build new infrastructure or buy products. So as the demand for that economy's currency increases, the price of that currency will go up in value. It's just simple law of demand. As with any product, if the demand for a product increases, its price will increase, because there's only a scarce amount of supply of that product, which is just simple law of demand. If, for example, the UK came out with strong GDP data, as I just said earlier, a business is likely to invest money into that economy where there's larger potential to growth. So if the economy is booming, China is a perfect example of this. Chinese economy has been booming for the last 10 to 15 years with GDP figures of 8 to 9% every year. So that's where people are investing the money. That's why so many products are made in China. So as there's large potential to growth in the UK, let's say with strong economic data, the pound will move higher against other currencies such as the dollar or the euro, because these banks will start buying up the pound in anticipation of whether they want to make a profit or whether the business might come to the bank and ask them for a certain amount of pounds. So the bank will then have to go into the market, buy these pounds, and then sell them to the business. And that's exactly how it works. So you need to understand that you're never wrong on the market, and that's another theory we just debunked. The market doesn't move anywhere, it moves in order to find value, and it's always looking for that value. Remember, the market's always curious, like it will look for those areas where it hasn't been in a while, or it will look to trap traders as well. So this was a perfect example where the lower lows made the market, yet the market just moved in the completely opposite direction, which is a very important thing to remember. And as I said, the market can only do three things: go up, go down, and move sideways. It always moves on people's expectations. So just remember that you're not faster than the market. And with millions of people participating every day, when news hits or when bad news hits, they'll be the first to withdraw their money. That's going into price. That's going in more into pricing, which I'll talk about later. But that covers the basics of the market movements and market nature.